Good evening, good afternoon, good morning, or whenever it is that you're tuning in to JB Financial Naked Tax Talk, where we bear down to the naked truth about who we are, our personal lives, our business lives, and our monetary lives. Because what I know to be true is that when we improve upon the self, our businesses, which is a reflection of who we are, also improves. And naturally, the money, which is a reflection of our business and who we are, also improves. And when you work with a certified tax planner like myself, we see ourselves making more profits and less taxes. I'm often asked, Jonathan, why do you have to always show up on your show naked? Well, the truth is that being naked is the ultimate form of feeling vulnerable. It's kind of like when you get a letter from the IRS and you panic. It's kind of like you realizing that when they ask to audit you, you don't have your financials, you don't have the books, or your records are a mess. It's that same sensation as if someone captures you and sees you naked without your permission, so to speak, or for the first time you are exposed. That feeling of being naked is the vulnerability that can be transformed into strength and into courage. It's like RuPaul says, we're all born naked, but baby, the rest is just drag. So it's just me today flying solo, and I thought that I would talk about the power of planning ahead in terms of our business structures, in terms of our taxes and our money. And I'm also going to open up today's show to your questions that you might have about your business, about your money, or anything else that you want to just type into the comments. Please make sure that if you're watching this from one of my groups like JB's Profitable Women's Profitable Entrepreneur Circle or Rapid Tax Savings Formula Circle or any of these other groups, that you make sure that you indicate your name, because otherwise it just shows up as Facebook user, and I want to be able to address you specifically. So without much further ado, let's just dive in and talk about the power of planning ahead. But before we can do that, we have to talk about the opposite of planning. The opposite of planning is this thing called reaction. Reactionary. It's this thing that all of us, for some reason, no matter what we're doing in our lives, something happens and then we react to whatever that situation is. And sometimes we're reacting like that, like the snap of a finger, and we're not thinking thoroughly about the consequences, the reaction that's going to come from overly reacting or simply reacting to a situation. You wouldn't believe this, but I see this a lot in entrepreneurship. Oftentimes entrepreneurs, and I get it, babies, because I've done this too, is that we sometimes have unplanned pregnancies. And I'm not talking about children today. I'm talking about your business. When I created Naked Tax Talk back about 2 years ago now, it was my unplanned pregnancy. I actually did not intend to create this show, or much less the name, but it came from being at a tax conference with a whole bunch of tax experts and me wearing a bathrobe because I was freezing my ass off in these conference halls. But I digress. Because I understood how to take the steps forward so that even though I had an unplanned business I just created, that I could move forward with it to set it up correctly. I created the legal structure behind it. I created the tax structure behind it. And I ultimately set up all of the documents put in place so that I could protect my newborn baby. Naked Tax Talk was born, I believe it was July of 2019. So it's only really a couple years old now. Unplanned pregnancy is reactionary to something. I truly will be honest, I was not planning on having a secondary business. But what I can say is that when we do not plan, or uh-oh, did I just lose audio? I think I might have just lost audio. Audio? If there's comments and you can hear me, please let me know. Don't know what just happened. Aha! There we go. All right. So, needless to say, there we go. All right. So, where was I all about this thing? Protecting, no, yes, moving forward. So, what happens is a lot of entrepreneurs is they don't know the legal entity structures. They don't know the tax ramifications of their actions. And so what happens is they find themselves in a bind, but they don't realize that they're stepping into that bind until it comes time to file their taxes the following year. And then they start to panic because they go, uh-oh, I'm going to owe taxes because I made money. Or worse yet, they fear that they're going to owe taxes because they don't understand the process by which the IRS helps to support entrepreneurs to continue to make money while legally paying less money. And so without the proper planning, we'll find ourselves in situations where, and I deal with this a lot, where people come to the door and they say, so yeah, I started a business and I, just don't know what I'm doing. And I think I'm an LLC. I did that first. And I heard on a radio show I should become an S corporation. And I figured out how to do that. And I did do that. And they're telling me all these things that they're doing. And then when I start to ask them the strategic questions like, okay, so you started an LLC, and did you do business with anybody else? And they go, maybe I did, maybe I didn't. Or they'll say things like, and I'll say that you said you formed an S corporation. So did you pay yourself the required minimum compensation, which is now required of you as a shareholder of your S corporation? What is that? Or I ask the questions, so how did you take money out of your business throughout the year to pay for your personal things as an S Corp shareholder? And they say, oh, I just kind of kept the same checking account where I pay my mortgage out of. What they don't realize is that they have completely invalidated their S Corp status on so many levels, or possibly their corporate status or their LLC status by the commingling of their funds. Or worse, is that Uncle Sam says that you, on an S Corp level and at C Corp to a degree, when you take out more money as a distribution, which is tax-free income that comes out, but it exceeds your, what we call your basis, your equity, what you put into the company, plus or minus your income or losses, when you exceed that, Uncle Sam says, oh, shareholder, what you really meant to do was to take out a gain out of your company, and now we're going to tax you with this thing called capital gains tax. It's a reaction. Uh-oh. And unfortunately, in a reactionary mindset, it costs us more money. Think about that for a moment. When we react, instead of taking a seat back and saying, what can I do to plan this out so it does not happen to me? It's actually less costly to plan things out and move forward than it is to be reactionary. Because unfortunately, the conversation that we have to have is a multitude of conversations, but the conversation we have to have is, well, what are your financials? How do I know that you made money or you didn't make money? I can't just take your word for it. As an IRS enrolled agent, I really need to be able to see some financials. As a guy with a degree in business accounting, I understand numbers and how they work. I want to be able to see it because numbers tell a story. And so what happens is we look, or worse yet, you don't have them. And now we're just guessing. Now you're asking for me to shoot a dart in a very dim lit room with no light and no target. And so we're just being reactionary to the case instead of being proactive. Well, what's proactive? Proactive is the ability to come in before the end of the year to talk to a professional such as myself and be able to plan it out like on a map. Interestingly enough, we call this a tax plan roadmap, where we actually plan out the steps that you're going to take in your business in order to accomplish the goals that you're trying to achieve. Being reactionary causes us more pain. it causes us more problems down the road versus being proactive. Now, I will give a lot of congratulatory points to some of my clients that have come in the door and have said, I have no idea what I'm doing. That takes bravery to do that, by the way, to be able to admit that you don't know what you don't know. And so when they come in under this pretense, we're able to actually talk with them and guide them through the process of the next steps they have to take in their life. Reactionary is not where we want to be as a badass business owner. We want to be in the driver's seat. We want to be the one that says, we're going to turn left in 1 mile. We're going to be able to cut cost here, increase prices here, attract the right people there. We want to be in the seat of control. And when we are in a reactionary state of mind, we do not have control. We don't. We are completely bombarded by everything else that comes through. And then if I may get a little philosophical with you and input just one thought here, which is this idea of karma. Karma, if negative karma is ripening in that right moment of time, and it's negative, we can feel the pain, the anguish, the feels like everything's against me, everything is just stopping me from doing what I have to do, versus, of course, if positive karma is ripening, and then we feel joy and happiness, and yes, okay, so one thing came up, I'll handle it next. But it's very difficult to change the mindset in the midst of a reactionary state of mind. I know that to be true even for myself. This is why I believe in being proactive in our lives, because being proactive means that I can set a wish, which means I can set the intention, which means that my body, my mind, my soul, everything will move into the direction of fulfilling that wish. And sometimes when it's reactionary, we have to back up, remove ourselves from that, bring the mind of awareness, bring the mind of mindfulness forward, and ask ourselves, wait a minute, I've been here before. This is the issue that we have to contend with. Understanding that being reactionary does nobody any service. Proactive is different. Proactive, we can take you to the next level. So this is going to be kind of a shorter episode today because, it's just me chit-chatting. And now, honestly, if you're hopping on, you're seeing me, and you have a burning, yearning question, especially about taxes, what a great way to get some pseudo advice free right now. But before I do that, I have to give you a legal disclaimer. And that is that what I share today with the questions that come up are not to be taken as tax advice. You must go talk to a tax professional like me. You must talk to a tax professional who can truly guide you based on your facts and circumstances in order to create the best path for you to move forward in your business, tax, and personal life. So I've got a question already coming in. Maybe we've already seen it. And it's called Slow the F Down Show, which, by the way, I freaking love that. So whoever you are, I want to be on your show too. That's perfect, right? Reactionary, we're flying into it. Proactive, we're slowing it down, and we're seeing where we can go next. So the question is I'm going to open up a joint personal account. Hey, Jonathan, is opening up a joint personal account considered a legal partnership? Thank you kindly, Casey. Wow. So, as with all questions, I need more facts in order to really understand. So, Casey, if you're watching the show right now, what I would like to know from you, and I'm gathering this based on this question here, but you said you're opening up a joint personal account considered a legal partnership. So my question for you is, what is the intention? What's the intention? So what I mean by that is that if we are going to come together, you and me, let's just say, two complete strangers, two single people, let's just say, and they come together with the intention of doing business together over a period of time. You don't know this, but you are about to get married. That's right. Not married in the sense that we know marriage. I mean marriage in the terms of business. You see, Uncle Sam says that when two individual people come together, or it could be two spouses that come together. So now you have foursome creating a partnership, but I digress. When you get two people who come together with the intention of making a profit, it is deemed as a default classification called a general partnership. A general partnership, more than two people who come together to do business. Now, I'm oversimplifying this concept for the purpose of this show. Trust me and believe me, this is a very, very, very complex tax behind the partnership. But to oversimplify it, to explain it, I say it like this: two people come together to make a profit. We call this a general partnership. If you have no legal protection in place, you are essentially a sole proprietorship, but with two people now, it's a general partnership. There's no legal protection here, and there's no real tax benefit per se. You see, why it's so complex is because in a partnership, when we know this about our own partnerships, is you can have one person who's the one who's like the dominant, right? Who's like the dom, who's like, yeah, I tell you what to do. Yeah, I'm in the mood. You're going to do what I want, right? That's the dominant. And then you can have someone who's like the submissive, right? Who's passive. And you can have a passive partner in a partnership too. And so in a passive situation, they're just like, yeah, baby, whatever you want. I'm just here to support you. Oh, you know what? You need some extra money because you got to buy some more supplies. Not a problem. Let me dip in and let me give you some more money called a contribution I put into the partnership. So that is essentially what you can have. But you can also have two people who are actively involved, right? In terms of like truly two people who are like, I'll do this and you do that. And together we make business. So it's about the intention. Are you intending on the together you I like that, you coming together to make a profit? So are you two coming together to sell a service, to provide a service, to sell a product? And then is your intention to split that between the ownership percentages? By the way, just like in regular human life, if you get married to somebody and you do not have a prenuptial in place and you break up, you have a divorce just like you do in regular life. You can have divorces and partnerships, and you break up. You could find yourself all of a sudden being forced to split all of your assets and cash and everything else inside that partnership 50-50, 50% by default. How fair would that be if you were the one that was getting up at 6 o'clock in the morning and working till 9 o'clock at night, Monday through Monday, and your partner did shit? And then you break up. And because you don't have a prenup in place, you go to court. And the judge says, sorry, Casey, I'm so sorry. But because you didn't have a prenup in place, we call this a partnership agreement. Because you didn't have a prenup, guess what? 50-50 split. They get 50, you keep 50, even though you did all the work. But in a prenup agreement, in a partnership agreement, you spell that out. I'm going to get X, Y, and Z. You're going to get X, Y, and Z. I'm going to contribute $100. You're going to contribute $100. When we break up and we split this down, I'm going to keep the house, aka office building, and you're going to keep the corporate car. I don't know. But the point is, you got to spell that out. Otherwise, you're going to find yourself in a whole hot water. So does opening up a joint personal account considered a legal partnership? Well, again, I need more facts and circumstances to truly be able to answer this question to its fullest. But I'm going to make some assumptions. So I'm about to make an ass out of you and me. But I'm going to assume that in this particular case, you and somebody went like, we're just going to start a business together, and we're going to call it a day. And so let's just go to the bank. And you go to the bank. And the banker is going to ask you, well, what are you guys going to do? Right? See, just because you tell the bank that you're going to open up a personal checking account in both your personal names does not necessarily preclude you from the partnership situation. And thank you, you're watching, yay. So yes, we're coming together to make a profit and do want to split the money that we make. So yes, so in this particular case, you are, and again, I don't know if you're chuckling or not, but I don't know if you know, but you are about to get married to somebody. And hopefully my thing for you is do you have a partnership agreement in place? Have you spelled it out? Have you spelled out how this is all going to work? Because if it does not work, the ramifications will be more costly for you. And we call that reactionary versus being proactive, which is to spell out all of the deets before you enter that agreement. So, you don't have to answer, but no judgment, by the way. But if you do have a partnership agreement, let me know that you do. If you don't, we got to get one. I mean, I don't do them. I'm not a lawyer, but I do know that if you at least got a document and spelled out what you want between the two of you, it's going to hold up because both of you are going to sign it and you each are going to get a copy of it. So, just so you know that when you both go into a partnership together, the tax ramifications are the same to a degree. And again, I say this with a caveat because the show isn't intended for personal advice directly. But when two people come together and they split out the income, the profit that they make, or the losses, but let's say the profit, Uncle Sam says, I want a piece of that. And it can be really expensive from a tax perspective. Because you see, the only thing that costs you money as an entrepreneur is tax. It's the only expense that you have as a business owner, and that's tax. Everything else that you're going to do in your lovely partnership, it's all an investment to make more money. And when we do this, like in my book, The ABCs of Deductions, An Entrepreneur's Guide to Tax Write-Offs, I talk about how Uncle Sam wants us to take time to read the tax code, which I've done in my book, just 28 letters, I think, or 26 letters, but it comes out to about 68 pages, to take the time to read the principle of each of the deductions behind your business so that you end up legally paying less taxes. Partnerships are tricky because, again, as I said earlier, the default classification is 50-50 split unless you agree to split that out differently. Are you both active? Meaning, like I said earlier, are you both in there in charge, working together, working your butts off? Or is one partner just cutting the money and you're doing all the work, right? There's different tax consequences for each partner. So yeah, so definitely. So you did mention we do not have a partnership agreement. That's not against the law. You're not, by the way, you're not committing a crime, and you're not, I'm not shaming you or anything like that, right? Just know that if you want to protect yourself and your partner, put together a partnership agreement. Spell out what you want before you start taking actions and moving money into joint checking accounts. Because that will get very hairy. And for my legal experts that watch my show, you can attest this to be true. By the way, I wanted to mention what did I want to mention? Consider legal partnership agreement. What else can I tell you about your partnership? Oh, so when you also formed this partnership, whether or not you did, but in a way you could have done this, you maybe have done this. You want to make sure that you take the steps to protect the legal entity structure. And just so my viewers know, we actually cover this in my course, Rapid Tax Savings Formula, which I'm super excited to start out. We're starting out with Rapid Tax Savings Formula 5.0. And that is coming out July 2nd. So mark your calendars, July 2nd from 2:30 p.m. to 2:30, 3:30, 4:30, 5 o'clock, so to 5 p.m. Pacific time, for 5 weeks. And we're going to talk about the profit mindset. So what it means to actually believe it, that you are worthy of making a ton of money and paying little taxes because of the way the law works. Understanding the full scope of separating yourself from your business. So when I talk about, like in this case of the partnership, the separation of the self, meaning the ability to see yourself not part of your business, but separating yourself from it. It's kind of like you're looking through a glass window into your business so that you can make the difficult decisions that you have to make as a powerful business owner. For example, the fact that you need to create a partnership agreement before you start doing business together, it takes guts to be able to sit with somebody. It's just like falling in love with your husband or your wife, or a boyfriend or a girlfriend or something like that. It's the same idea. It's like going to the person that you just met, like, your loved one, and then you're just like, let's get married, babe. Yeah, let's get married. And then we go, but before we do, I need you to sign a prenuptial agreement, and we're going to spell it all out. So all my money that I make now is not yours, and what you make is not mine. And you spell all that out. But it takes courage to be able to sit down with the other person and have the what if conversations. Probably the only time that's acceptable is to have the what if conversation. Well, what if you die in this partnership? Then what? Which, by the way, if that happens, and a lot of partnerships do not have this, you need something very important called key man insurance, life insurance. Why? Because here I'm going to tell you a little secret. Because what happens is that should your partner die, and let's say they're married, or let's say they have heirs, children of their own, well, the way it works is that when they pass away, the ownership of the business, their portion of it, transfers down to the children or to the wife or the spouse or the husband, right? All of a sudden, you have yourself new partners that you have to work with. And maybe you don't get along with the spouse. Maybe you two just do not rub shoulders the same way. All of a sudden, you're going to find yourself having to get out of this without a prenup in place, right? A partnership agreement. You're going to have to figure out how to separate yourself from them. So it gets really hairy really fast. So my advice, technically not advice on the show, but I would say, I digress, is that you want to have that conversation. What does it look like if this does not work out? What happens if this fizzles out? Should you die, what happens? So Keyman Insurance is pretty cool because what it does is it pays the life insurance beneficiary amount to the business. The business then uses that money and basically pays the partnership interest of the partner that passed away to the incoming partner, right? By subsequent of owning now because of the passing of the partner. Basically, you're buying them out. And so then you become the sole owner of the business. Something to consider. The other thing that you want to consider about your partnership is, although from a legal standpoint, without an LLC or a corporation in place, it's a default partnership and you have no legal protection, right? And I often say that when people practice in business without protection, LLC or C Corp, it's like having unsafe sex. And truth be told, you can check out, I did a whole other episode on entities and sex because I use them to explain what I'm talking about. But when you have unsafe sex, we know that it takes just one time to end up with a nasty infection, right? Potentially. And so when we decide to try to use safer sex methods like condoms, corporations, or dental dams, LLCs, it helps to protect us a little bit more. Unfortunately, Uncle Sam is a prude up to a point. And so he really wants us to be fully protected. And as a result, he's going to reward us. And so in Rapid Tax Savings Formula, we actually talk about the 4 major tax entity structures, what it means to form them, how they're formed, and then ultimately When do we move into new tax structures? Because legal structures are not tax structures. I'll say that again. So legal structures are not tax structures, meaning I can be an LLC and be taxed as a corporation or an S corporation or a partnership. So these are things we have to also consider. How do we want to be taxed? And to be honest with you, it's going to really be based upon the net profit that you're bringing into your business, and not necessarily like today, but like what do we think that net profit will be in 6 months or 1 year or so forth and so on. And we do that, by the way, through what we call our Wurbangle experience. So needless to say, this is the partnership scenario. If we plan your partnership out well, and you go through the steps of knowing, okay, I got to get a partnership agreement. I've got to contribute the money. We're going to form this joint partnership agreement. We're going to create the bank account, and all the things you're going to put in place is going to pay off in the long run. Like, as I just mentioned before, death, you break up, you get sued, all that other fun stuff that can happen to two business owners, much less one. So with that, I hope that helped. And if it did, please let me know so I know. Otherwise, if you've got more questions that you want me to address for you, now's the time to do it. But with that, if you are also curious to find out more in depth, first of all, I'm going to give you, if you'd like, including all my viewers and watchers, I know you guys are all watching, I'm going to put a link here called 5 Easy Steps to Financial Happiness. And it's my gift to you guys. And essentially what it is, it's what I call my seed method, my 5 pillars to profit. And what it covers is exactly what I just talked about right now. So Casey and to Miriam and the others that are watching right now, if you wanted to know more about these legal structure entity types, I highly suggest you tap in, get the access to the 5 steps. I talk about, I should say, the royal we talk about the profit mindset, separating yourself, the entity structure, deductions, and ultimately the way you ultimately protect yourself in the event of an audit. Because here's the truth. We spend all of our lives, decades. I was thinking about this the other day. I've been doing this for 18 years. 18 years I've been doing this. Imagine that if we didn't have the right foundation in place, all of it can just crumble. And so we talk about this in Rapid Tax Savings Formula. We talk about what is a document, what is a deduction versus an expense. Because that's how we have to really address and talk about our businesses. We have to really first step into the belief that we're a CEO and a badass at that. And with that, we can make the difficult decisions to start making a profit, like having the conversations with our shareholders or our potential partners. In order for us to then to step into the light of everywhere we go, we're always thinking, how does this relate to my business? How can I tap in to unlock and uncover and reveal the true opportunity that is sitting in front of me so that I can continue to make a buttload of money while legally paying less in taxes? And we do that through proactive tax planning. Remember earlier in the show, the power of planning ahead equals money. I'll share a personal story with you. So one of our clients just came on board this year, and they did the right thing. They were like, we don't know what the hell we're doing. We have no clue what we're doing. Please help us. So we were able to sit down with them, and I'm proud to say that year to date, we're already at over $287,000 in tax savings. Because we're being proactive, because we've pre-mapped out what they're trying to accomplish, which ultimately means that they're not sending a check to the IRS for $287,000. So now they get to turn around and reinvest it back into their business, hiring their employees. We all want that as small entrepreneurs, right? Hiring their employees that are able to go back and invest in the equipment in order to continue to do the job, and so forth and so on. So that's proactive versus reactionary, where I get people that come in February, March, and April. God help me. God help me. I'm going to pay taxes. I have all these taxes I have to pay. Help me cut my taxes. And unfortunately, here's what I have to tell them. It's illegal for a tax professional to help you cut taxes after the fact. I can do it legally moving forward, but I can't do it backwards. Now, there are certain things, that we can do, so it's not all is lost. But for the most part, to be really proactive, I can't do it in the past. I can only do it in the future. That's how you and I stay out of jail. Keep that in mind. So, needless to say, this is what it's about to be proactive. And I saw your response. Thank you so much. Oh, I finally just figured this out. I can post the comments so everyone can see them. Thank you. Appreciate your energy and how you explain things. Thank you. I just want to let you know, Casey and Miriam and all the rest that are watching right now. Honestly, this is what you're seeing. This is what you get when you sit with me for 5 weeks. Like I said, I'm so excited to start. We're starting July 2nd. And in fact, if you want to check it out now, I will give you access to Rapid Tax Savings Formula. And if you want, you can, in fact, purchase your seat now. And I also want to let you guys all know out there that we do purposefully keep the amount of students, and I call you students. And here's why. I was born to be an educator. I was born a teacher. I knew that I was going to be a teacher since I was about 5 years of age. Why? Because I would go to school and I would observe my teachers and I would actually critique them. And I would think to myself, when I'm a teacher, this is how I'm going to do it differently. Or if I really liked what they were doing, then I really honed in on that and I tried to capture that essence so that I can make it part of me. So I always knew I was going to be a teacher from the age of 5. All the way through. In fact, I got to university and I was getting my undergraduate degree in education. And it was one of my mentors who said to me, "You want to be poor your whole life?" And it scared me to death because I come from poverty. I come from generational poverty that goes back to my mother, my mother's mother, my grandmother's mother's mother, and it just keeps on going back and back and back and back. Generational poverty. And it scared me so much that I wanted to change. And I asked, well, how do you stop being poor? And his response, name is Paul, and he had said, work with money. And so while taking university courses, 13 credit hours, plus working a 40-hour job, I went and signed up and took another course in accounting. I got all A's. I understood debits and credits, all that. And I was in love, babies. And I turned around and I changed my major from education to business accounting. So I'm a guy who happens to have a bachelor's in business accounting, emphasizing taxation. And later on, I actually got my master's degree in secondary education after working for CPAs for about 7 years. And I actually was able to fulfill the first part of my dream. And that was to become the educator, to become the teacher, which I was born to be. And so I say students, because the truth is that we are all students, all learning all the time. So the students that I've helped through Rapid Tax Savings Formula, when they're done, this is what I love about it the most, is they're able to understand the complexity that I'm talking about. Now, they're not experts. I'm not asking for that. I'm asking for the foundation, because as a business owner, it is our responsibility to understand the basics of how things work. This is why Uncle Sam allows us as business owners to invest in our companies by investing and learning how to do the marketing, how to do the sales, how to cut your taxes legally to continue to make you money. This is really what it's about. My students walk out understanding the basics, the foundation. You see, they no longer come to me and say, "What can I deduct?" Because I teach them the foundation of the two fundamental questions they have to ask themselves to determine if it's an expense or a deduction. Which, by the way, you can get on my book, The ABCs of Deductions, An Entrepreneur's Guide to Tax Write-Offs. So, yes, Casey, I appreciate that. What you're experiencing today on my show is what you experienced me as a teacher with you over 5 weeks. All right, so it's coming up to about 5 minutes left, and I've got one more question that came in, and I can't show it here because it came through Messenger. And this is from Miriam, and she asks, my son just started working at an electric company. First of all, I need an electrician, just saying. And he makes about $17.50 an hour, and he works 50 hours a week. Dang, I thought I was bad working 40. Do you think that this will affect my taxes? He lives with me, and the money he earns is for his car's needs. So, in this particular question, what stands out are two important facts. By the way, if you notice, I'm saying facts and circumstances, because in the world of taxation, that's how we work with facts and circumstances. So, in the fact is he's making $7.15 an hour. Okay, that's fine. He works 50 hours a week. I'm not going to do math here on TV. I have a little 10 key right here. Every accountant does. And she's really asking the question of, am I going to have to pay taxes on this? Miriam asked, let me know, please, if this is true or not. But I believe this is what you're asking. We can see the fear. Is it going to impact me and my money? So here's my answer. Please do not take this as tax advice. This show is not intended to give you tax advice. It's intended to help to educate you, enlighten us, so that you can go to a tax expert like myself and get really spot on tax advice. So let's talk about this. So first of all, your son is 17 years of age. Yep, sorry, I forgot to mention this. He's 17 and he'll be 18 in October. First of all, happy birthday, October baby, because either you're like me, a Libra, or you're a Scorpio. Needless to say, 17, but he will be 18. So let's talk about that first. So I want to point something out about tax law. And that is that Uncle Sam only cares about one time in your life. 12/31/20, whatever the year end date is. Whatever that total income that you've earned all year long, whether as a taxpayer personal or as an entrepreneur and you have net profit or a loss, whatever that is at 12/31, 11:59 p.m., unless you elect to be a fiscal for businesses, but otherwise it ends on 12/31, 11:59 p.m. Whatever that is, that snapshot for the whole year is going to become the income that you're going to be taxed on. All right? So it also matters the age. So he's 17 today, but on 12/31 at 11:59 p.m., how old is he going to be? Well, Miriam says 18. So in that moment, he is considered an legal adult, right? He's considered a legal, there we go. Sorry, I was using the wrong language. A legal adult. And so every adult in the United States of America, all right, who are single, all right, we are allowed to earn tax-free income. Huh? Tax-free income, which we call the standard deduction. The standard deduction for 2021, well, golly Moses, I have so many things I have to always remember. And by the way, the standard deduction changed in 2018, fun fact, by the Tax Cuts Jobs Creation Act signed into law in 2018 that basically said we're going to raise the standard deduction, meaning tax-free money I can earn as a taxpayer up to a certain amount and pay zero taxes on it. And so for 2021, you are allowed to earn tax-free. By the way, if you're self-employed, this does not apply. There's some special rules and provisions, but I digress. Ordinary income, you're allowed to earn up to 12,550 bones. So $12,550 if you're single. You can earn up to $12,550 tax-free. Yay! So with that, Miriam, what your son can do is he can take his $17.50 an hour, multiply that times 50 hours, multiplied by 50 weeks, because most people get like 2 weeks vacation. So 50 weeks will give us an estimated year in total, and that will tell you whether or not he's going to pay some taxes. Now, the secondary question that you asked was about my taxes, your taxes. So if you claim him as a dependent, there's certain rules that you have to follow when you claim somebody as a dependent between the ages of 18, I think, till 26. It could be older too, but I digress. There's special rules that essentially say that you, like, for example, tax credits phase out and a whole bunch of other stuff that's really complex. But I digress. The point of the story is that your taxes will be not impacted and could be impacted. Yeah. So unfortunately, I can't give you really anything for there, but here's what I'll share with you. If you claim your son as a dependent, his income that he's earning, this is true for all children, that they're earning does not get reported on your personal income tax return. They file their own tax return. That's what they do. They file their own. So for the first time in his life, he's going to have to file his own tax return. Now, there's some complexity here because we have a dependency issue and, so forth and so on. But he could theoretically say, well, I don't want to be your dependent mom, and I'm going to claim myself as a dependent. And then he's just treated as an individual person filing an individual tax return. The complexity comes from the dependency. So in short, your taxes will be impacted mainly claiming the dependent or not. He's going to file his own tax return. You're going to file your own tax return. His income is not your income. Therefore, you don't have to report it on your return because you're responsible for only your income. Now, if I may, in the 3 minutes that we have, I'm going to go back to Casey's example of the partnership because this is where things get kind of hairy. So remember I said, in this case, the mom and the son. Son's earning his own money, mom earns her own money, but they file their own tax returns. Yay! In a partnership, when the two come together, Casey, you and your partner come together and you make some money, the partner is going to file its own partnership tax return. It's called a 1065. It's very complex. And it's going to basically collect all the income, all the expenses and everything else, the balance sheet, all that stuff goes into it. And then what happens is the summary of all that tax activity on the 1065 partnership return, it's going to get split and it's going to get put on a form called a K1. And on that K1 is the summary of your portion listed out. Your portion of the income, your portion of rental income, your portion of this, your portion of that, And then on your personal income tax return, you're going to indicate that as income, the K1. And again, you're going to then address the taxes at that point. And by the way, a general partner in a partnership is subjected to self-employment tax, mandatory for any net income over $400. Yikes. So this is a moment in which we can proactively plan for your future. And there will be an investment to do this. But I promise you that the investment is always, always worth more than the cost of expenses. So with that, I hope that my show was of benefit to you. And if so, thank you and please accept my gift to you. If you are a watcher and you're a viewer and you've got some tax questions of your own, please feel free to join me here live on Thursdays at 6 p.m. where you can pose your questions and I will fully answer them the best that I can to help to enlighten us so that every single one of us as business owners can step into the glory of who we were born to be. Badass CEOs capable of making better business decisions that leads to more profits, less taxes, and ultimately the ability to fulfill our dreams, but the dreams of our family. So if you've really enjoyed today's show, please subscribe and hit the alert button. And also, please share this episode and encourage others to subscribe as well. I'm Jonathan Bengal here with Naked Tax Talk. One last thing. Let's always remember why we became entrepreneurs. It's to make mucho, mucho, mucho dinero.